Hey everyone, this is Kirk here again at Option Alpha. So welcome back to part 2 of this little mini behind the scenes series that I'm doing on finding a new 1-day, 1 DTE options trading strategy. So first of all, if you haven't watched part 1, go ahead, just pause this video. Link right below this video to part 1 of this little series here. Go watch that one first, come back here. I won't be offended. You can pause this one, come back, and then we'll watch part 2 because we're going to get right into it here, exactly where we left off from the last one. As always, we'll have links to all of these back tests, everything in here right below the video link or video description, so you have access to all of those. If you have any questions or comments, let me know. I hope you guys enjoy this. So where we left off last time is we had this baseline strategy. So I'm just right now calling this the baseline strategy because I'm going to do some more testing. We're going to do some testing together. I've already done some testing, so you don't have to sit here and watch me run back tests. But this was the resulting strategy. The basic setup here that we had for the baseline, which is kind of our working model at this point, is a SPX next day position. So if today is Monday, this would expire Tuesday. And we're going to try to hold these positions through to the next day. I don't want to be tagged as PDT. I want to make sure this is good for small traders like myself. And this one is an iron condor. We were doing the short legs, so the inside strikes of this iron condor, $5 below where the stock was trading or where S&P was trading, $5 above, and then the legs are $5 apart. So it's basically just like a squared box iron condor right around where the market was trading. Further down, you can see we're just trying to keep everything very consistent across capital and allocation. Right now, we can kind of massage those later on, maybe in a different video. We can go through that a little bit more. And we had settled on right now for this baseline model. Again, we could hopefully find improvements to this. Today, we had settled on about 3:30 entry time, and then trading days all days, skip FOMC, slippage on the way in. We had a gap range, so we're trying to eliminate these big gaps that happen in the market, and then an opening change, again, trying to eliminate big opening changes that we have, so huge up days, huge down days. We want this thing to be tight and narrow, so we're trying to filter some of these out. We did a little bit of filtering on RSI. It doesn't hurt. It only did a couple little trades. And then, of course, we have exit options, none right now, so there's no exit options. We did test in the last video doing some different profit-taking levels. Didn't seem to improve it. We can come back and revisit this here soon if we find anything else. But right now there's no exit option, so we're just going to let the thing go all the way to expiration. Win, lose, or draw. It's cash settled anyway since it's SPX, so it makes it easy. And we do include slippage on the way out. Also, again, I'm a big fan of this because I think it helps really stress test your back tests. If it works out with a lot of slippage included, then it's probably a better test anyway. So on that note, just kind of talking through, I know people had questions about this. We got emails about it, questions on the last video, but just for like ideas and discovery, one of the things you can do inside the backtester is go to this tab here for top backtests. And so what this does is it basically is a database of all these crowdsourced backtests that we're all collectively running together. And you can use this as a way to generate ideas. Now, I'm not a fan necessarily of going here and saying, I'm going to pick the top backtest and just use the top backtest. And I'll show you why, because anything can backtest. But then this is like the part of trading, I think, where you have to use your mind, like have to use your logic and say, okay, does that really seem possible, or how might it be different for me? So let me just go through an example here because I'll show you. So I went in here and I did this, and just kind of walking through what I did. I would go next day, SPX, strategy, iron condor. The period that I wanted to trade was 3 years. I didn't really care about win rate or average ROR right now, but I wanted to make sure it had more than, let's say, 300 trades, and it was at least the last 5 days. And so that, like to me, that gets kind of like sift out a lot of things, and you start to see different things. And these are kind of different strategies. You can hover over these and see what they're actually doing here, basically in their strategy setup. It's not everything, but you can kind of see it, right? And so what I did is I went down here and I said, okay, let's pick out something like this one here. So this one looks okay, right? Decent, like, I noticed at first a higher profit factor, which I kind of like. Lots of trades, so that's really good, right? And so if you wanted to go ahead and just use this one, just go ahead and open this one as an actual trade right here. So, okay, this looks really good. So I see this chart, I'm looking at it, I go, this is up and to the right. This is the perfect potential strategy. Not that it can't work. I'm not saying it can't work, but here's the way that I go through it. I hope that this helps out. I'm just kind of explaining it. So the logic of the strategy makes broadly makes sense. I understand what they're doing in the top side of this strategy over here because it looks very similar to what I'm currently doing with mine, right? So the logic here is Iron Condor, you do a 45 delta, so you're still selling at the money really close, $5 above, $5 below, no harm, no foul, okay? Like logic makes sense. It's very similar to what I'm doing, just surprisingly it ended up being that, right? Not that it could be different. So then you get down here and you see they're doing things a little bit different. Allocation doesn't really matter. It's just starting capital. One position size, okay, that's about the same. Trading entry time is 10:30. Okay, interesting. Could we try to test some things that are a little bit sooner in trading time, right? Trading days, Monday through Friday. Great, no problem. Seems pretty basic, seems pretty straightforward. So then we get down to the bottom, and the bottom is profit taking at 10%. They are avoiding PDT, which is good, which means that even if they get into this trade, they're not going to get out of it until the next possible trading day at 10%. Now, the only issue that I have with this, and this is where I start to say, okay, how could I run this strategy, which seems more realistic to me? Not that it can't work. Again, I'm not bashing this person who ran the strategy, just trying to think through, like, how could I run this that seems more realistic to me? And so the way that I thought about it is I said, well, I would definitely want to include slippage. So if you're going to get in and out of a trade, I think that including slippage, really stress test it. If it works still with slippage, great. The other thing with 10% profit target is that sometimes 10% might be there for a fleeting moment and then gone, and it might be just a mispricing. So I'd want to make sure that it hits that 10% target multiple times. Like it's really solidified that you've got a 10% profit, not that there was just a slight mismatch in pricing at one point and just kind of bid or, the mark or mid went to 10% profit. So what I actually did is I actually went ahead and just reran this backtest with a couple of these different factors. So here are the results from doing that. So what I did is I took the same one there, just open a new tab, and then I did slippage. So I included slippage both ways in test number B. So you can see here on the right-hand side, all I did here was include the same exact strategy. And then I said, all right, look, no one's perfect on trade entry. What if you have a little bit of slippage getting into the trade? It's 10:30 in the morning. You can still have some time, but markets are moving. So include 5 cents of slippage getting in, okay? And then down here for profit taking, 10% profit taking and slippage of 5% on the way out, still avoiding PDT. So I'm doing all the same stuff that they're doing. And further in the description, if you go to edit it, I'm also requiring at least 2 hits at the profit target before I get out. So again, that means if the mid price of the trade just for a brief moment in the backtesting history of all the data we have just shows that mid price is 10%, I'm not going to get out unless it shows it at least 2 times. So that's really important. Again, not going to exit on the first day. I call this test basically slippage both ways. And you can see that once you include slippage, it goes from up here to down here negative. And again, I'm not trying to like smash somebody's strategy. I'm just showing you what I would do to stress test your strategies right now from the beginning. Because what I don't want to see is I don't want to see people just blindly copying the strategy. Then they actually have slippage in a real market environment, right? Not a backtesting environment, but like a real market environment. And then you find that your strategy doesn't work or it doesn't work the way that you thought it was going to do. So just from the start, include slippage, do the more aggressive backtesting now. It means that you're probably going to find things. It means it's going to be harder to find things, but they might be better things. So then the other thing I said, I just try to, play devil's advocate here and say, well, look, maybe that's too aggressive, right? Like you're getting into a 10:30, you're at the money strikes. They should be pretty liquid. There's 0 DT on SPX. So let's assume that you don't have slippage on the way in, and but you have slippage on the exit. So you can get into a perfectly priced trade. You can get in at your price you want at the time you want. But let's just say that we have slippage on the exit. That's it. So the only difference here is that this one just includes slippage on the exit, which again might be kind of middle of the road, realistic to say, look, we might not have aggressive slippage, but we got some pretty good slippage on the way in, and or good pricing on the way in, and we need some slippage on the way out. That one did turn this strategy into an okay, decent winner. It was not a huge right home winner, but it was a good one. Win rate 60%, pretty interesting trade, high trade count, which was good. What I don't like about this one necessarily is it felt like you're picking up pennies in front of a steamroller because you were literally getting $3 on the trade for a win. So it really felt like it was too early on. for that particular strategy. So again, this is just a way that I think about it is, like use some of this back testing. What I did is I went through the top back tests back here in the top back tester or in the 0DT back tester. I went through the top back tests. I opened up a ton of tabs and just kind of exploring what people had done, what different tests they've run, how they were setting it up, and then use that as my own basis for testing some other things moving forward. So here's one that I found just to kind of keep this train moving to show you how I do it. So I found this one in top back tests. This is the setup right here. So what they were doing is they were doing an iron condor. This one's actually a little bit different. So SPX, iron condor, next day, still same stuff that I had filtered for. They were doing kind of an unbalanced or skewed iron condor. So rather than doing it right around where the market was trading, they were doing this at a -35 delta. So a little bit closer on the put side, maybe some bearish skew, if you will. And then on the call side, they did the short call at the 10 delta, so a little bit further out of the money, maybe giving the market to room a little bit more or run a little bit more. And they had long legs of $10 on either side. Starting allocation for this one that they ran was $10,000, which was good. The position size was a contract. Entry time about 220, so still in the same ballpark, which I thought was pretty interesting. Slippage 5 cents on the way in, 5 cents on the way out. They had a very small VIX filter here of, basically any VIX values below 25 and profit taken at 20% and avoiding PDT. So all these are checks for me. So this is one where I look at it and I go, okay, this is pretty interesting. Like, what could we do with this? How could we test some new variations? And so what I wanted to do is go through an example of how I might go through this process of adding variations. Again, people had asked for more examples of this, so I'm going to give you guys it. And I'm doing this blind, so I don't know what the results are going to be of this. I don't know. This might actually change the way that we do the rest of the video if we get different results from some of the other tests that I've already run. But I'm going to add a variation here. The first thing that I'm going to do here is probably play around a little bit with the short strikes and potentially play around with the actual credit here. So you could potentially do this in a couple stages. What I like to do is kind of focus in on one particular set of things that might, change it. I don't want to change too many things at one time because I want to see what kind of moves the needle here. So here, let's go ahead and start maybe with messing around with the credit here. So they did 20% of credit. Let's go here. Let's test a little bit, something a little bit lower. Let's do 10% of credit. Who knows? We had that other one that ran at 10% of credit. So I'll change here and we'll do 10% credit or 10% profit taking as the test. So we'll put that in the description, run that back test. While that's running, we can just create another variation. Just spin these up as quickly as you want to spin these up. I think theirs was 20%, so let's do like 40%. And then we'll do a 50% one as well. So we'll spin up another variation. Again, you can just literally spin these up as quickly as you want and test multiple variations going through here just to see if anything works out. And actually, you know what we should do instead of a 50%? Let's just run it to expiration. So let's do one more test. Let's do E, and let's do expiration. So we're going to have no profit taking. Just run it. I don't know. Maybe kind of the VIX filter and the way that they're setting up their spreads, maybe it actually works out. So we'll set this one that expires. Okay, so once we do that, all of those tests are now going to be running. And so this is the screen that you'll see where you see that your back tests are running the different scenarios here. You can see the different statuses. What I think you should do in this case is just run a bunch of these, open these up into new tabs, and then at that point you can come back and once all the tests are finished, kind of see the results. So what I'm also going to do is I'm also going to open up this strategy in a new tab again. So I'll get that same one here. While these tests are still running in this tab, go to this new tab, hit the compare button to jump into the compare mode. And then I'm going to add some variations from this. Now this time what I'm going to do is I'm going to mess around with some of the deltas here. So I'm going to mess around with some of this, move this up here. Let's do a 40 delta and maybe just adjust that one a little bit closer. We've seen some good results with 40 to 45. Maybe we even go to 45 delta, go a little bit closer here. Give it a little bit more room on the top side, but go a little bit closer to add the money. Some of those other back tests that we've already run, seem to do well there. We'll keep everything else the same, and we'll go down here and we'll say 40 delta put side. So we'll do that. Then we'll do another test. You can just do it from the baseline scenario if you want to. Let's go a little bit further out this time. So let's go down here to like a 25 delta. Go a little bit further out on the put side. So 25 delta put side. And then we'll do another test from the beginning. And again, you just mess around with these. Just whatever you want to do here. Let's go a little bit closer in on this one. So we'll go to like a 15 delta on the call side. So maybe collecting a little bit more premium, taking in some more delta on the call side. Maybe that works out. And then we'll try one more going even closer on the call side and see if that makes a difference here. So let's actually just go a little bit closer on the call side, like I said. Let's go to, I think we went to a 15. Let's go to like a 25 on the call side and see if that changes it. And take your time with describing these and putting descriptions in there. It really does help out, especially if you have a bunch of tabs open. Then you can just quickly come in here and see like what is the main difference here. You don't have to go too crazy with the descriptions. Sometimes I find myself I do, but if you're just quickly doing these, then go ahead and just put some quick descriptors in there so you just know what the actual differences are and you don't have to keep looking at them. So, all right, so what I'll do is I'll pause the video here. We'll come back when some of these results are done running. All right, so this test finished running, so let's take a look at the results. First set we're going to look at here is the different profit taking that we did. So this one was pretty interesting. If we let the positions go to expiration, that didn't work out. So remember, baseline here is strategy number A, and you can see, mostly speaking, strategy number A is the top strategy. Again, it doesn't matter where it ends up. Like I think that a lot of people look at that and go, you know, when they look at backtest and compare it, they're just looking for the one that ends right here. And sure, that could be important too, but it's also the path in which it takes, right? If the strategy that ends up here took a path like this and is like, I don't want to trade that strategy, right? So, so you just need to look at that. But right now, strategy A, which remember, this is 20% profit taking, looks like it's about the optimal profit taking or pretty close to it. The only one I think that kind of comes close, strategy E, letting it go to expiration, did not work. So that was kind of suboptimal, especially when you look at things like profit target here. The only one that kind of came close is if you took like 40% profit, you were kind of in the closer ballpark too. E was closer there too. Looked like it was just a more optimal strategy, kind of smooth things out, maybe a little bit with C, but at the end of the day, it really didn't look like it was taking much. You could see the value and the benefit of early profit taking, although sometimes it doesn't work out, but you see the win rates for 20% profit taking. This win rate was the highest for 10% profit taking, but the P&L for 10% profit taking was actually the lowest in the testing group that we did. So that's like kind of the trade-off that you sometimes have with profit taking is you are going to get higher win rates, but it doesn't always equate to more capital. You just got to find that happy medium for different strategies. So that was an interesting one. So I would do that. If you go look at the other set of tests that we ran, this is the set of tests that we ran just now on the different legs and deltas. So trying out different spreads on one side or the other. You could just further expand this out if you wanted to too, but just as an idea, this one was going a little bit further out on the put side, a little bit closer on the put side, further out, and then closer or further out and closer. So same thing. When you look at kind of the results, obviously E is done, or C is done, E is done, B is probably done. So it looks like the only viable one that came close, and the lines were very close together, was actually D, which is this one. So just kind of focus on that one as we go down. Now, when I look at this, it might be different than you, but there's a couple things I'm looking at. So I like looking at, of course, the total P&L. That's, of course, important to see. The maximum risk at any point, I like to see that as well. That's just basically like at some point, how much was the maximum capital we were risking? And then the max drawdown peak to trough. So those are always good ones here. You can see D had slightly better maximum drawdown. The max risk was a little bit higher, but it wasn't higher by much, $500. And profit factor is another good one. I like looking at that. That one's actually a little bit better in D as well. Win rate was about the same. You trade a little bit more positions here. Didn't get as many filtered out for that one, so there's probably more available strikes. That's probably why that shows. If you go further down to some of the P&L metrics here, I like that the P&L here on the average trade is the highest, so a little bit better than this one here. Your return on risk was a little bit better here. Your risk to reward or reward to risk was a little bit better here for D. So it made sense that you saw probably a little bit better metrics for D. So if I was using this as a new baseline, I would say, okay, this is, kind of the new baseline moving forward. So I still am not going to use this one right now, but you could, of course, go ahead and just use the links right below. You can make your own variations as you will. So here's some other ones that I found and kind of in my exploring research and just kind of showing you some different things that I've looked at and before we kind of get back to that base scenario and just keep going from there. But just this was another one. Somebody had traded a 945 entry at a 15 delta and just let it expire. So I said, okay, well, let's try that. The 945 let it expire. That A test was a winner. And I added on top of that some in the money touch expiration. So this is a really fun one where you can basically say, look, if the position goes in the money by $5, so in this case negative, it goes in the money by $5, then get out of the position. So here I tested $5 in the money, 10, 15, and $20 in the money. So essentially the idea here with this strategy was you sell a really, really far out 15 delta iron condor. So you're selling premium really far out, collecting a little bit more premium, hoping to get a really high win rate. And then if you see that the position goes further and further in the money, exit the position. So this one was pretty interesting. It actually looks like, if you do nothing, that was probably the worst for these in the money or for these 15 delta iron condors. That was actually the lowest payoff was the test that I saw that was from some of the top back tests for filtering out. So pretty interesting. You just actually improve it by just using some very basic filters here for just exiting the positions early, not letting it go full to expiration. So it was a pretty interesting one. It ended up being that basically about B and D ended up being okay. If you go down here to some of the metrics, you can see a noticeable improvement. Strategy 1 was just over par for profit factor, and then B and D were pretty good improvements. Same thing here. You actually lost out on win rate, but you actually won overall. You saw dramatic improvements in your average P&L. You saw improvements in your return on risk, which was really good. Again, very fascinating to kind of look at. Saw this other one in there. I took a stab at this one because this wasn't a top back test, but just an idea that somebody had thrown out to do a 45 delta and then take 15% profits. So this one, again, is doing that very simple contract. It was 15% profits instead of the 20% profits that we tested from before. 45 deltas, so you're doing it right at the money or very close to at the money, but earlier in the day this time. So this one's a little bit different. Kind of same setup as something we tested before, but this one's earlier in the day. Basically the idea was, look, can you sell something juicy, fat, premium for the next day and use profit targets to kind of optimize the exit? And it looks like if you did optimize the exit by getting out early, that was actually your best move in this case. This is what the fun thing is about backtesting. People ask this all the time. What's the best, profit-taking level? Well, it depends on the strategy all the time, so you should test it because one profit-taking level is good for one strategy, another one, it's going to be completely crap and garbage. And in this case, and we showed this in the last video, profit-taking for our baseline strategy was not helpful. If you ran this particular strategy, profit-taking was helpful. So you should test this out, right? Taking profits at 15% was the best case scenario. You still lost money, so these are all bad strategies. And this is kind of the idea with finding things like this and kind of testing different profit targets is that, like when I look at these, I go, okay, nothing really helped this strategy, right, at this point. And you could test other things like filters and whatever, but at its core, and this is why I kind of think it's fun with backtesting to me, is this is what you should be doing as a trader because it allows you to find things like this that no matter how much massaging I give this thing, really nothing worked. Right? It was all down and to the right. So there was no improvement that we saw, like dramatic improvement that we can then further dig into. If we had seen one of the tests start to go like this and go completely the opposite direction of the other grouping, okay, now we have something that's dramatically impacting performance. So now we can dig into that further and do some more variations on it. But when you find things like this, if you test some ideas and you kind of spit around with it for a little bit, you don't find anything, just keep moving on. All right, so let's go back here to our baseline strategy and just kind of work from this. This is a test that we did. This one was kind of using the logic of the in the money touch that we had used on one of the other back tests previously. So kind of applying this logic to the baseline scenario is what I did. So I did our normal, just to kind of reset us here, 330 entry, next day, $5 wide strikes, $5 out from the money. We did our 1.5% range, very small RSI filter, 1.5% gap, and let it expire. That's our baseline scenario. So now what we tested here is we tested 15% in the money touch, 25%, 50, and 100 just for kicks, just to see if it improved performance anywhere, and it really didn't. It really didn't improve performance at all. You can see if you're getting out of this position early for this one, it just really didn't help you because you were so close to being at the money. It meant that they were going to swing to in your direction very, very quickly. I think B kind of tells this story really, really well. This could be synonymous with a stop loss order as well. It's like if you're trading these at the money positions or close to at the money and you execute some sort of stop loss or touch, which is like a variation of a stop loss, then it probably is not going to be helpful because it's just going to get hit. The markets are just too volatile and they just get smashed. So you can see the B was our worst performer, turned a good strategy into a complete loser just by adding that one thing. The more you just let it go, not to quote a Disney song because my kids are kids and I've listened to that song a million times, but the more you let it go, actually the better the returns ended up being. So until you just kind of got rid of it completely. So you can see here, still profit factor was 1.5. Max drawdown was kind of the best that we had here. Win rate was still the best here for this one. You go down here, your average P&L per trade, your average return on risk. I mean, like it was still the top dog, if you will. So that really didn't help. So then enter into it another variation that I tested. So I just, again, opened up strategy number A on a new tab and went through, again, a different set of variations. This time what I did is I went back and did a little bit wider strikes. So instead of doing a $5 wide, it's still the short put and short call are still $5 above and below. Now what I did is I said, look, what if we threw in here a $10 wide position? Now noticeably, this is going to increase our risk per trade, but does it improve the metrics, like the underlying metrics of the strategy just by going wider? Do we get some better movement, maybe the better credit, gives us better win rate, things like that. So I didn't change anything else. Everything else is still exactly the same, but I just went $10 wide strikes. So here I did $10 wide strikes as a baseline for 3:30, and then I changed up the time. I said, okay, well, $10 wide strikes, let's just test while we're doing it. $10 wide strikes at different times during the day. Maybe getting into a bigger credit, letting it mature longer might help out. But you can see that that did not help at all. So getting into it earlier in the day didn't help at all. This it really just kind of like jives with what we had for this particular set of tests, where we were getting into it at 9:40 in the morning, just like nothing worked early in the morning. And then we come here and we test it with a different set of parameters about 12 o'clock, and that didn't work at all either. So it's like kind of reconfirming now that this early entry for a next day position may not be the most optimal for what we're kind of looking for. So maybe a later day entry for a next day. So then when you go to 1:30, things get actually significantly better for D, just like 1:30 got much better. C at 2:30 was underperforming, the other ones at 1:30, and then you get B, and B was above that. Now all of these, or a few of these, were above our starting value of A. So again, that makes sense in its like on the surface because we're adding risk to it, so we're allocating more capital. So it's much easier for this P&L chart to kind of go like this, right, and make it that way. And so what we can do is we can actually try to mimic this to some degree by editing test number A and just basically doubling up on the contracts. Now, I'm not necessarily a fan of doubling contracts just to double contracts. You can do that as a position sizing thing. But just to kind of give us some baseline scenario, we can definitely edit test number A, which we'll do here in a second. Double up on the contracts. That makes it a little bit more like apples to apples comparison of risk. But before we do that, let's just kind of go through some of the metrics, because I think this is still helpful even if you get scenarios like this where you have different metrics in there. If you look at the profit factor on A, profit factor, and you can just use D or B as kind of your, maybe your go-to value test. But here, look at the profit factor of test number A, 1.5. Nothing was higher than 1.5. You did get better win rates on these positions because they were a little bit wider spreads. That kind of makes sense on the position. So you did improve your win rate there. If you go down here to your average P&L, Of course, the average P&L is going to be less here because it's less risk. Look at the risk, $81 versus $200 in many cases. But then your return on risk is still higher here, right? And your risk to reward ratio still higher here. So even before we kind of run this with double contracts and basically add more risk to this position just to make the P&L curves about the same, you can kind of look through these metrics and see that you probably did better just with even with these. Like the strategy itself was kind of at its fundamental level, just a little bit better. But just for fun, let's go through and do this. I actually don't know where the results are going to be. I assume they're going to be obviously higher than some of these, or at least a better line. But we'll go here. We'll do this. We'll do $5 wide strikes. We'll do 2 contracts here, which will be the difference maker. And we'll see where this test ends up. We'll just pause the video and come right back when it's done. All right, so test number A finished rerunning. Again, this is with 2 contracts, and you can see it's the blue line here, but you can see that that line is a little bit more stable than some of the other lines here as it's kind of meshed in there. Now it's a little bit more realistic. It's a little bit more apples to apples. Of course, this one won out. It made more sense. We can just in our head do the math around it, and it would have been better. Max drawdown was better. You can see the profit factor was better. Win rate's the same strategy, but now you can see the average P&L is now back up to par or better than the other strategies that it was running on. So it's still a better strategy overall. So we want to use this one moving forward. But again, it was a good test, good way to test it. Do we go wider on our strikes? In this case, we don't go wider on our strikes. We definitely don't change up the timing. Seems like we're still kind of hovering around this 330 zone. So all right, so here's the last set of tests I run. We'll kind of end on this one and just go from here. But the last one I ran is I just opened up our baseline strategy again in a new tab. So back to $5 wide from the market, $5 wide strikes, baseline scenario. We're keeping 330 the entire time this time, so that did not change in this. So we've kind of already tested that out a little bit. And so now what I did is I started to mess around with a little small filter for above and below different moving averages. Now my thought around this was if we get into a situation where the market's tanking and starting to go down, let's say it dips below one of these moving averages, then it may not be a good time to do next day trades because the likelihood is that we're going to see a sequence of negative returns that day or a sequence of positive returns where the market just jumps one day and jumps the next day, right? We see this because we publish research on it that, very volatile days are followed by more volatile days. So is there anything around this that we could do where we could say, look, above and below certain moving averages, we're not going to touch it? So what I tested here was different SMA moving averages where in this test number B, it would only enter the position if it was above the 10-day moving average for SPY. That's it. That's the only change that I made to it. Here we tested above the 30-day moving average, here the 50, and here the 100, just for good measure, just to see, is there anything in here that can help us trade less trades, better trade entries, more profitable entries, smooth out our P&L curve as we go forward. So, and you can actually see that some of the results are pretty promising. They're very close, so we should go through them together, okay? So you can't really tell from the chart, but you can see a lot of these are kind of moving in the right direction. And at the end of the day, our test number A was this one down here, and this grouping of tests was a little bit better above, which is very interesting to me. So when I see this, when I see like my baseline test either higher or lower than the other groupings, maybe there's something here. So let's just dig into it a little bit more. We'll kind of walk through this. So if you look at total P&L, obviously there's some differences in total P&L. Let's just scrap that for a second. Look at the fundamental metrics of the trades that we went into. So first thing that I look at here is, of course, like profit factor and max drawdown. When you look at these ones across the board, you can see strategy number B had a lower max drawdown and lower max risk. Same thing with C, had lower, slightly lower, okay? So it did look like end to end, it looked like we actually improved the risk characteristics of the strategy by including these small filters at whatever level they were. So even at the 100-day moving average, right? If you look at profit factor, it looks like you're kind of focused in on these two right here, which would be B or C. Those are two kind of the, well, I mean, I guess D is in there too as well as higher profit factors, but you definitely improved it across the board. So let's keep moving forward and keep looking at this. You go down here to win rate, you can see we improved win rate as well. So we went from 21% win rate to a quarter win rate. It's not super high win rate. If you like win rates, you might want to go for a different one, maybe if it makes you feel better. I don't really care as long as the strategy generally wins out. So that was important to see. Also here, we saw number of trades. We were originally trading 643 trades. We've dropped that down considerably, which is very cool to see that we had less trading activity and actually higher profits overall, higher profit factors. So again, these are good metrics, which is showing that like the whole thing is moving when you apply these filters. It applies across the board. It wasn't just one freak thing. Like the whole lot of them started to improve the metrics. The one that kind of stands out right now to me is strategy number B right now, highest profit factor, lowest number of trades. So pretty interesting. This would be above and below the 10 moving average. Which was, I think, pretty interesting here. You get down here to some of these metrics, these average P&Ls. The first one, of course, is we improved it. In some cases, doubled the average P&L. So in this case, it went from 9 to 17. This was still the highest here. And then you look at the return on risk, the highest here for strategy number B, risk to reward, still the highest here. I think to me, strategy number B ends up being the winner. I think you can make a good case for strategy D as well. Which was a really close one also, but close one in the sense that D won the most money, but B seemed like the better metrics. Like the actual metrics of the strategy seemed a little bit better. Maybe the P&L curve was a little bit smoother also. Maybe didn't get as much volatility in that P&L curve. So to me, B seems to be the current winner right now, and then that would be the one that we're going to use moving forward for any baseline test. So it's a pretty fun one. Again, I'll open this up here in a new tab so you can see this one. This would be strategy number B. If we just look at it by itself, you can see a pretty good P&L curve. I like it. Again, this is including lots of slippage. So slippage on the way in, slippage on the way out. So if it does well with slippage on the way in, slippage on the way out, plus everything else we tested, it looks like a decent strategy that we might want to move forward with. So I'll leave this video here for now. I don't know which one we're going to go after. We might do one more round of variations and testing in part 3, but I do hope you guys enjoy going through these and kind of walking through these different back tests and seeing what I think about them. Hopefully they help. If they do, let me know in the comment section below. If you found this video helpful, please give it an upvote, give it a like, give it a share it with a friend or a trader that's out there. Again, I'll put all the links to everything that we talked about here right below this video so you can take a look at them. Would love your feedback. Love your different ideas, different things that we can test, and how you would use this moving forward. So until next time, happy trading.